Dividend stocks have been destroyed since the beginning of the year, so today I'll share with you 3 great Canadian dividend stocks that are currently trading at discount and that are offering some massive potential of upside over the next couple of months and years. Without further ado, let's take a look at my pick number 1. The first business on my list is the telecommunication company Bell with the ticker BCE. This business that currently worth slightly less than $50 billion has lost about 15% of its total value since the beginning of the year. But first, before to understand why Bell could be a great buying opportunity for many people, we must understand how they are able to generate all their cash flow. As Canada's largest telecommunication company, Bell is offering a wide variety of products and services to their customers, going from TV to mobile phone, as well as high-speed and wireless internet and residential home phone services. Plus, this business also owns a lot of different subsidiaries, from Bell Fibe to Bell Media to Lucky Mobile and to The Source. And they also own a certain part of Canadian sportive teams such as the Montreal Canadiens, the Argonauts of Toronto, and the Toronto Maple Leafs. All of these different products and services that are offered by Bell have helped them to generate over $18 billion of revenue over the last year, which is representing a slight drop compared to the same period last year. But an excellent point for the investors about this company is the market in which they are evolving, which is the telecom market considered as a triopoly over here in Canada. So basically, it is a market that is divided between 3 big companies, which are Bell, Rogers, and TELUS. In brief, it means that those 3 companies own the largest chunk of the 40 million Canadians that are using the different telecommunication products and services. Today, more than ever, we are in a connected society where everyone has their own phones to see what is the overall actuality in the world, which means that all of these people need to have different suppliers to have these products, for example, the internet, which will be provided by Bell. And so, with the project growth of the Canadian population over the next couple of years, we should see some massive increase in the demand for these kind of products and services. But in that case, why has it lost so much value since the beginning of the year? Well, the first thing for Bell, as for most telecom companies as well as dividend aristocrat companies, is the fact that they have a lot of debt to their names. In the case of Bell, we can see it by the debt to equity ratio that is illustrated to over 160% at the moment. And a concerning point about the debt of Bell is that it has been growing over the last 12 months, where its total equity has been diminishing. And this simply means that the business itself will be massively dependent on the future variation of the interest rates. But what gives me great confidence about this business, despite the bad macroeconomic conditions at the moment, is the fact that they are still able to continue to grow their important business segments that should see some great progression over the next couple of years with the increase of the population. And so when the interest rate will decrease, this company that currently has a great price to earnings ratio of less than 20 should see some great growth in their total valuation. And while waiting, keep in mind that this business is offering you about 7.50% of dividends per year, which is quite higher than the average savings rate that you can find at your bank. But at the same time, with a super high dividend payout ratio, it might mean that this dividend could be cut in a near future. Now, next up on my list is one of the members of the big 5 banks over here in Canada, which is the Royal Bank of Canada with the ticker RY. This bank could represent a great buying opportunity for many investors that are looking for great stability while receiving about 5% of dividends per year, and where the stock is down of about 10% since the beginning of the year. As a bank, you can understand that it is offering a bunch of different financial services and products to their customers, from credit cards to bank accounts passing by different loans. And with over 17 million customers all around the world and over $2 trillion of assets, it is the largest Canadian bank by market share and the second largest one in terms of assets under its management. Interestingly, for the investors, we've seen that RBC has still been able to grow their total revenue year over year compared to the same quarter but last year. And so we've seen that the largest chunk of their $23 billion of revenue in their latest earnings report has been generated from 2 big business segments, where you have the personal and commercial banking as well as their capital markets branch in Canada and in the US. And an important fact is that when it comes to the key categories of the personal and commercial banking making over here in Canada, RBC always comes as the leader in that field. So once again, why has it lost about 10% since the beginning of the year? Well, first, the banks are running against some extremely strict rules over here in Canada, where the regulator has been recently raising the minimum capital requirements. Currently, the banks must keep a common equity tier 1 ratio of at least 11.5%, and the analysts expect this ratio to climb to 12% in December, adding more pressure on the lenders of this country. This ratio is simply showing what is the financial strength of these banks by simply dividing what is its equity capital to its total risk weight assets. And it means that those banks must increase their total capital buffer to be able to pass throughout different financial distress situations where they could become eventually insolvent. This is some pretty good news itself, but concerning the fact that RBC is looking to buy and purchase the HSBC Bank for about $13.5 billion, well, it means that this company will need to issue more equity, which means that they will need also to contract more debt. And so with about $460 billion of debt, you can understand that this company is extremely dependent on the variation of the interest rate, because in fact all the banks around the world are making the largest chunk of their income from what is called as the spread, which is the difference between the interest rate that they'll pay compared to the interest rate that they'll receive from different deposits. It is why, for example, if you want to borrow money from RBC, well, your interest rate that you'll have to pay on your mortgage will be way higher compared to what is the average Canadian interest rate. But at the end of the day, with an excellent price to earnings ratio of about 11, some super great profit and operating margin over the last 12 months, and a beta of less than 1 showing that this company will tend to fluctuate less compared to the overall market, well, this company could represent a great buying opportunity for many investors looking for great financial stability while receiving some great dividend income every single quarter. Especially knowing that the ex-dividend date is coming on the 24th of October 2023, it means that it might not be too late for you to buy this stock to receive the next dividend. And last but not least, I've decided to include a company that I've talked a lot about recently, which is the energy company Enbridge with the ticker ENB. On its side, this business that's worth about $100 billion is currently down of about 15% year to date, but at the same time, this business is still one of the largest energy companies in the entire world, and it also offers a juicy dividend of close to 8% at the moment. So once again, let's explore why this company has lost so much value since the beginning of 2023 and why it could represent a great buying opportunity, especially for all the dividend income investors. But to be able to understand Enbridge performance over the last couple of months, you need to understand that Enbridge profit is mainly dependent on the price of oil. Indeed, as we can see by its big operational branches, Enbridge is transporting about 30% of the total crude oil that is produced here in North America. It also moves about 20% of the total natural gas that is consumed in the US. And with their more recent storage utilities acquisition from Dominion Energy, well, they become the largest gas utility business by volume in North America. Add with some interesting projects that are currently underway in terms of the renewable energy, where Enbridge can currently generate enough electricity to meet the requirement of electricity of about 1 million houses in the country. All of this makes that Enbridge business model is well diversified and is greatly adapted to tomorrow's environment. However, the big problem with Enbridge, as for most oil companies at the moment with those current macroeconomic conditions, is the fact that they are known to have some reverse relationship with the interest rates. In fact, in the short term, when the inflation is increasing, it will usually lead to some increase as well in the oil price. But on the long term, when the different federal banks decide to increase the interest rates to reduce the total growth of the economy and to control the total inflation, well, it makes that the price of oil will usually drop. It is notably what we've seen that happened throughout 2022 as for the beginning of 2023 with the multiple hikes of the interest rates, and it has obviously been reflected in the valuation of Enbridge throughout that period. However, more recently, we've seen that the multiple hikes of the interest rates have started to slow down, which has obviously massively helped the price of oil. But the problems with Enbridge is that even if they are starting to slow down the hikes of the interest rate, well, as for the other two companies on my list, they also have a lot of debt, which means that they will be also massively dependent on the fluctuation of the interest rates. But a more positive news for the investors is that this company has still been able to continuously increase their free cash flow year over the last couple of years. But on your side, if you want more information about Enbridge, make sure to check out the video that I've made on the subject more recently. So there you have it. Those are 3 great Canadian dividend stocks that are currently undervalued and that are worth having on your watch list for the next couple of months. Obviously, we've seen over the last couple of weeks and months that the Canadian market has been harshly hit by the multiple hikes of the interest rates, but at the end of the day, the Canadian companies will have the advantage to fluctuate a little bit less compared to the American companies, and which will result in more stability in your overall portfolio while receiving some great dividend income from most of these companies. But on your side, if you want to find 3 ETFs that every Canadian should have in their portfolio, check out the video that's gonna be right over here, and I will see you soon. Peace!